Let's talk to Tim Gregory. He is an investment manager at Vermeer Investment Management. Morning to you, young Tim.
Morning, Nick.
Right, it's my crib sheets. G7 into G8, Brexit, FOMC, ECB, Mr. Trump. How on earth does a fund manager factor all of this into his portfolio?
Well, with great difficulty, I guess is the simple answer. There has been so much news flow from a sort of macro and geopolitical point of view, and so much more to come this week. So it's been almost impossible from a day-to-day basis to try and figure out what's going to happen next in the very short term. So quite simply, we have been running, our portfolio with a maximum number of stocks, which is 60, with a continued degree of balance that we've talked about regularly on this show, with some cash, so that we have the opportunity to put money to work in the event that there was a sell-off that creates some opportunities in high-quality businesses we like. And by sticking to the stocks and the companies that we trust, we'll continue to deliver good profitability, good cash flows, from a very broad variety of sectors, really. So, it is very difficult day to day, nigh on impossible, because the news flow can be, one day you can think, oh, it all looks very bleak, trade war concerns, and then the market seems to be able to shrug that off. And then this morning we have what looks initially positive conference summit between North Korea and the US. And then we move into the FOMC, and tomorrow night's the Brexit amendment vote, and it's very, very difficult to position with any confidence and security on the basis of the news flow that you can't be sure of how things are going to play out.
So, first question: why 60 stocks and why not 70 or 50?
Well, we just like a balance between a very high conviction portfolio, which we would regard as 30, and 60 was a number that we chose that we felt would give us enough balance without getting too long a list of names and forcing us to continue to always be re-evaluating the stocks we own. Because when you own 60 stocks, it means there are a lot of stocks that we don't currently own, that we admire, that we think carefully about. And we sort of have almost a promotion and relegation system whereby if something comes onto the radar and we've got the full amount of 60 stocks, then we've got to relegate what we think is the weakest brethren, which is always difficult.
Right. Going back to the FOMC, okay, if they don't basically up rates, do you think there'll be a sell-off like there was previously when the market got kind of spooked? Oh, what does the Federal Reserve know that we don't know?
Well, I think for a start, they will raise rates. So that would be a big shock. And so it could spark as you say, what are they seeing in the economic data that tells them that they shouldn't be raising rates? Well, on the evidence that we currently see, nothing, because the last set of jobs data that we saw showed strong job growth, unemployment at the lowest level for a very long time. We see in the conference calls that we do with a number of companies and the analysts that we talk to some pockets of wage inflation that tell us that they will raise rates and that they should continue on the path that's been set out. And I'd be really surprised if they don't.
Right. Okay, so an old adage, sell in May, go away, come back on St. Ledger Day. That hasn't worked in recent years, and I'm not clever enough to crunch the numbers.
Sure.
Do you go into the summer more cautious, more worried? It just strikes me that, the Italian situation kicks up just ahead of the summer period. A lot of the big money people are sitting on the beaches, okay, therefore it's illiquid, they're not making decisions, okay, and you get that higher volatility. What's your thoughts on that?
Well, as you know, we've been saying probably too often that we think the market's stuck in the trading range, and we still think the market's stuck in the trading range. So we've been positioned much the same way most of the year, whether it be in May or earlier this year. I think it's a very fair point that what has surprised people is that markets have probably been stronger and got particularly in the US, back towards the top end of the more recently established trade range, but not got through it, as we've talked about a lot in the past. So, we haven't adjusted our strategy because it's May. We've been running with this float of cash. If the markets did get back up towards that 2870 level we saw on the S&P 500 before, we would look carefully at the portfolio and look at the valuations and see whether we took an even further defensive position. But these markets are teaching us you've got to be very flexible in your mindset. And we've had cash, and that's when markets have been good. Clearly, that's a drag on performance, and one's got to be careful about that. And the 2 weeks ago, to your case in point about the Italian situation, I can recall going in after Bank Holiday Monday, market looked really difficult. But by Friday, the Italian political situation appeared to have found a compromise. The US jobs data was great. US markets were running very strongly. Bond yields, meantime, instead of having broken out above 3% that everyone was worried about, had come down a long way because of the Italian situation. There'd been a risk-off move which had taken 10-year US Treasuries back into the 280s. And so even when they've moved higher, subsequently, they're still not above 3. So, at the moment, despite all that news flow, we're still in this sort of no man's land position on bonds, which probably will be a decisive factor where they break out to, which we've talked about a lot to ultimately. And that's really, that was an extraordinary, every week has been extraordinary, it kind of feels like, but that week particularly did seem extraordinary, starting the week so negatively on Italy, and by the end of the week, everybody being completely complacent again.
Okay, so finally, because that's me, what's your favourite theme area of the markets at the moment?
Well, we've been...
What's hot in the back of your mind?
Well, I think the long-term themes that remain structurally very strong, which take you away from the day-to-day news flow, the growth in the Chinese consumer, factory automation, those types of underlying themes remain, and I think they're reasonably well understood by the market, and they're reasonably well, but they are the long-term growth themes for investors, and so we try to stick to finding new ideas in those areas and checking on the ideas that we've got in those areas, and try not to be too diverted by the dynamics of the day-to-day, which are so difficult.
Good advice on that note, Tim. As always, thank you very much for your time.
Thanks.